Chapter 2: Evolution of Management Accounting.
In this chapter, students will be able to describe the evolution of management accounting using IFAC model. Also, be able to explain the relevant laws of traditional management accounting techniques in the modern business environment.
What is management accounting? SIMA defines management accounting as the application of professional knowledge and skill in the preparation and presentation of accounting information in such a way as to assist management in the formulation of policies and in the planning and control of operations.
The National Federation of Accountants (IFAC) analyzed the evolution and changes in management accounting through 4 stages. The 4 stages are Stage 1 – Cost Determination and Financial Control, Stage 2 – Information for Management Planning and Control, Stage 3 – Reduction of waste in resources used in business process, and Stage 4 – Creation of value through the effective use of resources. Stage 1 – Prior 1950, management accounting was defined as a technical activity necessary for the pursuit of the organizational objectives.
The focus was mainly towards cost determination and financial control. Well-known method introduced during this year was first in, first out and last in, first out.
Stage 2.
By 1965, the focus had shifted to the provision of information for management planning and control. Another development in this stage was capital budgeting techniques, which are Return on Investment (ROI), Internal Rate of Return (IRR), and Net Present Value (NPV).
Stage 3.
By 1985, the focus in this stage was the reduction of resources waste in business processes.
During this period, the increase in competition and rapid technological development affects many aspects of industrial sector. The techniques developed were just-in-time, activity-based costing, and economic order quantity. Stage 4.
By 1995, the focus was mainly towards the creation of value through the effective use of resources. This was to be achieved through the use of technologies which examine the drivers of customer value, shareholder value, and organizational success and survival. The technique introduced were activity-based management, total quality management, and benchmarking.
In order to perform better and effective than competitors, the company should be able to produce products and services which meet the needs and desires of the customers. Long-term generation and adequate distribution of stakeholder value can be achieved by the efficient use of well-formulated and developed business strategy. Due to the globalization, the company is not only compete locally but are exposed to the international market. An attractive price, good quality product, speed of delivery, and good customer service are significant factors to attract the customer locally and internationally. The larger size of the company can easily create a global market. In order to create global market, the company have to formulate the strategy of management accounting. Advancement in manufacturing technology is a contingent factor that could impact the management accounting practices due to the differences in the production methods and product, causing different cost measurement tools to be adapted and thus different management accounting practices designed. The organizational factors involve organization, strategy, products, perceived uncertainty, and competition. These factors are affect directly the day-to-day operations in a company. Organizational factor is related to internal control within the organizations, for example, new management style.
Relevance loss refer to intangible loss to the organization even though the organization obtained huge profit when using traditional management accounting. This happened when all systems developed was no longer suitable for the current environment. The relevance loss also occurred because of the inappropriate ways of using accounting information to manage business and not because of using improper accounting information. Hence, this leads to the lack of useful and timely information for better decision making in the business.
Next is the criticism on the relevance of management accounting. Based on the book Relevance Laws, The Rise and Fall of Management Accounting 1987, there are few lines of criticism on the relevance of management accounting. One of them is questioning on the limited proof of technical developments within management accounting practices. The productivity, flexibility, and quality of the business have increased, but there are no evidences or reports by the management accounting. The next criticism is the belief that management accounting only focuses on preparing financial reports. This causes other goals of the business to be ignored and management's decision-making to be irrelevant to the current situation. The final criticism is focused more on the history of the management accounting. The firm should also recognize the beginning of management accounting tradition as it was well established in the 1920s instead of only focusing management accounting as a recent development.
Next, I'm going to talk about the effect of relevance loss in management accounting. Based on our finding, some of the effects are misleading information, too much production, and report is not complied with the current standard. First of all, relevant loss leads to misleading information. Since relevant loss occur when traditional techniques used in modern environment, company has used wrong measurement and all system. The information produced is not updated, hence this will cause the management to make wrong decisions. Next, too much production is also one of the effects of relevance loss. In traditional management accounting, they focus on the production activity without concern on customers' demands. Relevant loss occurs when the management keeps on producing and ignores to meet the requirement of customer. This is not relevant to the modern business as modern business concerns more on customers' need in the production. The last effect is the report is not complied with the current standard and situation. The preparation of report based on traditional management accounting will make the report to be too aggregated, not up to date, and irrelevant to the current management. Hence, this will lead to the relevant loss of the management accounting.